Howdy, Jacob here. Next company on our dividend yield stock screener is Enterprise Products Partners. Let's get into some details here. So, $57.2 billion market cap, 7.6% yield. Yield looks pretty exciting right now. Pretty high net debt for the company, as the enterprise value is $84 billion versus their $57 billion market cap. That's $26.5 billion in long-term debt, up from $14.6 billion 10 years ago. So not quite doubled, but nearly doubled in 10 years. Let's see what that is in comparison to their cash flow. So about 26 billion. Looks like the last 2 years they've been paying down debt, when the previous 8 years they've been issuing more debt. So good that they're starting to see that they can't just keep issuing debt forever. But if we look at, what did I say? Okay, so 5-year average, let's see, 6.3, 2.6, 2.0. Let's say it's about $4 billion in free cash flow out of 26. It's like a little over 6 times. So I definitely like it to be lower than 5. Is really what I look for. So they do have quite a bit of debt in relation to their free cash flow, and they're paying out a lot through their dividend. They have about $4 billion, let's say, on average the last 5 years. And again, that's the most recent two, getting $6 billion and 6.3 nearly billion. So they're paying out a very hefty amount for their dividend. And they paid a $3.2 billion acquisition. They use cash for that? Yep. Okay. So we can see their cash balance went from 2.8 billion to 76 million to help fund that acquisition, maybe a little bit of paying down debt, dividends, such. So let's start making some assumptions here. So for me, if I'm looking at the revenue, 47 went all the way down to 27, down to 23, and then from 23 jumped wildly 21 and 22. Looks like there was the acquisition in 22, but not necessarily 21. Do they producers and consumers of natural gas, crude oil? I mean, they've jumped up so recently. I don't see a way in which that lasts. I see it being similar to something over here, where maybe in the near future it jumps down quite a bit, but then goes back up to where it was prior. So for me, I'm going to have to assume that there's no growth, the 10 PE, just because it looks to me, just from what I'm seeing, a very cyclical company, and it feels like it's at a peak where the last 2 years have jumped 50% and 42%. I feel like it might go down before going up again. Again, everyone else has their own opinion. I try to be on the conservative side. And so for me, I'm saying 0% for right now. As for margins, earnings have been a bit higher. Let's assume 10, 8, 0% share change. I said the dividend was pretty much paying out fully where it was at. I might say, you know what, let's have you pay out 2/3. So instead of 4 billion, we're paying out 2.6 billion or so. I think that's a bit more reasonable. So for me, that gets us to a value where it needs to drop by nearly 50%. So I feel like the fact that they're starting to pay down debt in the last 2 years versus issuing debt the previous 8 years means that they're understanding that they can't just keep issuing debt to fund everything else that they want to do, whether that be acquisitions, paying down, or paying out a dividend. But I like that they've been positive every year in free cash flow for the last 10 years. That's great. For me, I would definitely want to put this company on my list of something to look at when it becomes a more attractive price. Because there's just been a lot of interesting activity the last 2 years where revenues jumped so significantly. But for now, I'm just sitting on my butt and waiting until it gets to a price that I want to do more research at. So thank you, and I hope everyone has a good rest of your day.